Well, hello everyone. Welcome to Trading a Smaller Account. My name is Barb Armstrong. I am a coach and senior manager with Schwab. I have Connie Hill with me today in the chat. She's a friend and fellow coach. So together, along with all of you, the usual suspects, and if somebody here is brand new, please start type a greeting into the chat so we can welcome you. But we link arms here every Monday and Friday, and we're figuring out this trading thing. And we start at the beginning of every year with 25,000 now in our small account. For some people, they might look at that as a smaller section of a larger account that they want to actively trade. But, we're doing different things each and every week. So Friday, we had a pile of cash sitting in the account. And so we did a number of stock trades. Today, we're going to head over to the vertical side of the equation. We're going to look at some long call verticals, some short call verticals. We're going to talk about, how you can trade these perhaps in a higher probability, maybe a more conservative way, shall we say. Um, uh, you know, but we're going to have a discussion on verticals. Okay. And then we have a little bit of housekeeping to do, otherwise known as trade management. We're going to look at some trades that we're going to place examples on, and we're going to look at some stocks where we might decide not to, because I get asked a lot, how do you choose, which stocks you use as examples? And so I think it's worthwhile looking at some of the ones that didn't make the cut as well. Okay, so that's what's on the agenda for today. If you aren't following Connie and I on X, I don't know what you're waiting for. Consider this your formal invitation at Barb Armstrong CS. Connie is at Connie Hill CS. Now, I did find 3 imposters today, and at least 2 of the 3 have been shut down. But just know that no coach at Schwab will ever reach out to you and offer you a Bitcoin deal, a crypto deal, education that's just for a select few for a fee. We won't offer to trade your account on your behalf should you be willing to share this is the scariest one of all, your sign in information with us. Like, yeah, these are all scammers, my friends. So just be aware. And if somebody does reach out to you, please have a close look at the handle. If it isn't at Barb Armstrong CS or Connie Hill CS, know that that's a scammer, and let us know and we'll get them shut down. Okay, so having said that, let's have a quick look, just to remind us that options carry a high level of risk and aren't suitable for all investors. Know that we use the Paper Money software application on the Thinkorswim desktop platform. Also know that one of the differences or nuances is that, Paper Money, it will not assign a short option position early. And that can be, in a live account, being assigned early could be a blessing and it could be a curse, but we discuss that, okay, in this class, in spite of the fact that this is something that won't be assigned early, short options. Okay. Okay. So we usually do a super quick market overview. This morning, Scott Durfee and Kevin Horner 4 days a week does a fantastic market overview at the market open. So if you haven't been checking that out, I encourage you to do so. We're going to look at 4 of our existing trades, lickety split. It'll be real quick. And then we're going to spend the rest of the time looking at new positions or potentially new positions and having conversations around those. So let's come out and have a look. And this is something that I always do on Mondays. Um, so the first one is to look at the S&P. And it's not hitting a new all-time high today, but it's up almost 2%, and it's within a stone's throw of it. So pretty hard when we've hit a new all-time high, just back here in June, on June 2nd, to call this anything other than bullish. How about the NASDAQ? Does it look similar? Like pretty dang close, right? And again, it's not at an all-time high, but with a semi-decent arm, you're within a stone's throw of it. How about the Dow? The Dow 30, new all-time high today. Yeah, not too shabby. And how about our small cap? So this is 2000 of the smallest of the Russell 3000, and that's hitting a new all-time high today. So where's the VIX going to be? Well, I'm guessing lower. Uh-huh. Yeah, down at 16. So it's just showing that like there's a lot of confidence, shall we say, in the market. And then if we come over and we, come over to the S&P 500 sector indices, and we say, okay, who's been, really trucking the last 3 months? Technology back in the lead. And financials are coming around. Like they were kind of sidelining it and going a whole lot of nowhere. And actually, we did trades on a financial stock on Friday. It wasn't Fitbit, it was Fifth Third Bank, and we're going to look at that. We'll look at that today. So, that's been strong. Communications looking like a bit of a diagonal resistance breakout here. Consumer discretionary, another diagonal resistance breakout. Okay. So that's the extent of, our market overview. Now we have almost 33,000 in this account, and we have a cash of 7,800, but we do have one conditional order waiting. So on Friday we did some stocks with targets, and one of them was DXCM, which we're not in yet because we put in a conditional order. So let's go and look at DXCM. And one of the things that we said on Friday, and if you missed that class, it is available in the archives, and Connie will put a link in there. And this class, somebody asked if this class was being archived, and unless there's a technical hiccup, it certainly will be. But, if we look at the 1 year chart, we had this big double bottom, it broke out and it came back to retest. And we said, well, if we want to be sure or have a higher degree of confidence, because it may have been down on this day, like when we put this in, we put in a conditional order to say if it goes 20 cents above 76.25, we'd like to get in. So our entry was at 76.45. So, but today, it's still flirting with, is this old ceiling going to act as the new floor, old resistance is new support? But let's pretend this was our closing candle. So our high here is 75.70. So we might say, well, if tomorrow it goes 20 cents above that to 75.90, then we'd like to enter the trade. So we're going to update. So I'm going to post these alphabetically, and we are going to cancel and replace this order. We're going to come to our sprocket, which has our conditional entry, and say instead of 76.45, we're going to make our entry on this 75.90. And then we're going to leave our target and exit the same. Because if we come back to the monitor tab and we look at DXCM, we had a target of 93, which was based on the width of the double bottom. And then this was about 3% below or support. So we'll leave those the same. Okay. And if we come back out here. So we've updated our conditional order. And, when I say, like, if you put a conditional order in, it's not a set it and forget it. And we're not chasing it. To me, chasing it is when something's going up dramatically and you keep trying to put an order in. We are doing the opposite in that we're being patient and saying we only want to get in if it really bounces off the support level. And if it doesn't, then we could be avoiding placing a trade that might turn out to not be profitable. Because if it breaks this support level, it could turn out that this breakout wasn't a true breakout. Maybe it was a fake out, and it could come all the way down here. So okay, so that's that one. Now, I talked a bit about the fact that we'll never be called out early, but on TRIP, we bought 400 shares. This is an inexpensive stock. So on TRIP, we did a buy right at $15. So we bought it here on Friday. And this morning it gapped up. It went all the way up to, it actually opened at 1360, hit 14, and our covered call is at $13. Now, if we were called out on this, and we won't be because it's paper money, but were we to be called out on this, would we be sad? No. In fact, I would say, hell no. We'd be like popping the champagne. It's a little early, but I guess we could make mimosas because we'd have reached our max gain. It is now trading at 12.95. It's just below the 13. But we're up kind of nicely. And if this continues to go up and we get called out at 13 and it's trading at 14 or even 15, are we going to be sad? No, we're not. Because we had a conversation with ourselves and we said, self, if we can get called out at $13, we paid $11.73 to get in. So the most we can make on this is $127 a contract times 4. If we could make $500 on this, $508 less transaction fees, we'd be thrilled. And so what are we going to do? Nothing. Absolutely nothing. Okay, so I just wanted to talk about that and kind of put that in context. So Jim is asking a good question. Could we close it early or should we wait? And you know what? I had this exact thought myself, and I was going to do a little survey today and say, should we wait? And then I thought, well, just a minute. How much can we make? Well, we could make $508. We've made $140. So, maybe we just kind of let this ride a little because we were willing to be in this for 32 days. Okay. But some people might say, hey, I made $144 over the weekend when the market was closed and it gapped up this morning. I'm happy to take that and no one would fault you for it. But retail traders have a reputation for kind of taking profits early. And we've got a third of our gain, like about a third, not quite, maybe 25%. Just over 25% because, we could make 500 on this. So we're going to kind of let it ride. Okay. Okay. So there's that one. Apple, we're underwater on. So I just wanted to have a quick look at Apple also. Because with Apple, some might look at this and go like we're underwater by 122%. Now, if this were a different type of trade, but with a short vertical, we tend to, it's like a 3-to-1 risk reward quite often. And so, we sold this for $1.35. It's now trading at $3.15. Our strikes are at $3.05 and $300. So it's through both strikes. And so that's kind of interesting because when I started trading this, I was expecting that if it was through both strikes, I'd have my max loss. And we're like $185 away from our max loss on this. So we're not even close. We have 17 days to expiration. So should we close this out? And what would happen like if this were assigned? So because when we sell a put here at 305, we're saying, hey, we're willing to buy this stock at $305 a share. That would be a $30,500 position. We only have 32,800 in this account. So we can't afford to buy it. So what we might choose to do is exercise our right to sell it at 300, and then we'd have locked in a max loss. But the probability of it being assigned goes up as we approach expiration, and we still have, I think it's 17 days to go. And it's come down, and like the market did come down for a few days, and this came down with it, but it's rallying. And so we might say, we're just going to keep an eye on this. And if it continues to go up, we could end up with a profitable trade. So we're going to continue to watch it. The markets are closed on Friday, and we will not be hosting live webcasts Friday. But next Monday, if this hasn't repaired itself, we may be out of it. Okay. Yeah, so NVIDIA is another one. So somebody said NVIDIA is getting a nice bounce today. We already have a long call vertical on NVIDIA, and we were underwater on that. But we've kind of retrieved half our loss. So we're still down 20%. So if we look at NVIDIA, and this is where this whole patience, and like there are times I'm not a big fan of patience, but I know that it's a skill. And this is why having a trading plan and having the discipline to follow it is so important. So nice bounce today. Here are our strikes, and we have, until July 17th for it to get back up there. And so again, we're exercising patience. And like it may get up close to here and maybe we're closer to breaking even and it looks like it's going to roll over, then we may just exit the position. Okay. So that's all we're going to do for review today. Let's go and look at some new opportunities. And this one was on my list on Friday. PanW. And we just didn't get to it. 45 minutes, it goes awfully fast, but here's a stock, Palo Alto Networks. If you're not familiar with PanW, you can read this down here. It's based in Santa Clara. The travel team, including myself, we were just in Santa Clara a few weeks ago. It was a great event. But it's part of the tech sector. And this is up 54% year to date. We had this bull flag came down to kind of this area of support, right? And it's bouncing. And so if we were bullish on this and we said, well, you know what? This looks like it might continue to go up. Given we have a conditional order, we can't really buy shares because we've invested most of our money currently until we liquidate some positions. But could we do a long call vertical? So if we come to the trade tab and we say, okay, if I do this long call vertical at 270, so if I come out to July, so we can do it two ways. It's trading at 283. So if we're bullish, we could say do the 280 and the 290. And what's that going to cost us? $4.70. Now it has to go back up to 290, but like it was just like at the beginning of June at 302. So that doesn't seem like a huge stretch, does it? This is what a trader might be thinking to themselves. Now, but you could also say, well, just a minute, like what if I did the 270 and the 280 and then it just has to stay above where it already is? It doesn't even have to move very far. Like, I wonder what that would cost. Almost $6. Now, a little earlier this morning, it was a bit less than that. If we wanted our 50%, it would have to go up to almost $9. And so if we're bullish on this and PanW's in the tech sector, the NASDAQ has been strong. The tech sector is, the leading sector over the last 3 months. We might just say, well, I'm okay with doing that 280, 290, paying, significantly less for it. And if I have that target of 50%, it may not have to go up that much for me to get my 50% gain. But we at least looked at it so that we could make an informed decision. And so if I say, okay, 470 times 1.5, when it gets to 705, I'm going to exit the position. And you might say, well, you could make $530. You could make more than 100% return on your risk. And it's like, yes, we could, but we could also lose the entire amount, and we'd rather not be greedy. We'd rather just say, okay, if I can make a 50% return in 32 days or less, how many people think that kind of return is not adequate? Like go to a barbecue on the 4th of July and just say, like, can you believe this woman suggested I take a mere 50% return when I could have made 100 in 30 days or less? Like, they'll ask you if you're committing a felony, if it's legal. Like, and this is legal and I'm joking, but it's just like, and this is a lesson I had to learn when I started trading, and this is why I share it so often. But we're risking $465 in this class. We don't want to risk more than 500 to 550. And so we're going to just do one contract, even though our goal in our example trading plan is to get out if it goes up 50% or if it goes down 50%. And we're not basing on getting out at 50%, because then we do two, because we're trying to be conservative. And so this is one of the ways in which we're trying to be more cautious or conservative, in that we're trying to protect our little heap here. And if we look at this, we have the 270 and the 280 and the 290 strikes. We have an 86% chance of it hitting that, a 40-some% chance of it being in the money at expiration. We don't really care that much about expiration, because if it goes up and comes back through, if it goes up enough, we might have hit our 50% target and end up out. So cool beans. So not being greedy has served us very well in this account. So I'm going to put this in our long call vertical bucket. It doesn't seem to want to let me pick a bucket at the moment, but there's PanW. Okay, so let's come and look at Amgen. So Amgen's in the healthcare sector. And that one's kind of been coming around the bend too. Like when we look at this, like we had this kind of double bottom on the sector. Some might say, ooh, there's a little cup and handle. It's come out kind of retesting, but there are some stocks in this sector that have been doing well. And so if we say, okay, Amgen, I see when I play I Spy with my little eye, this little diagonal resistance breakout came back to retest, moving to the upside. So could we do a long call vertical here? Or, or could we do a short put vertical? Excuse me. But when I look at this, if I come out to July, 975 to 1065, that's about $1. So that's acceptable. 1210 to 1315. Like when I looked at these earlier, actually, these were wider than this. And so my point was going to be that the bid-ask spread was too wide. But it's kind of tightened up, and we've got 400 contracts. So when we look at our example trading plan, this does trade more than 1 million shares a day or more. We've got, a sector that's turning around with a stock that is turning around in a market that's bullish. So could we be bullish on this and do, say, the 355 and the 360? So if we look at that, it doesn't have to go up that much for us to hit, our 50% gain. It's got to go up, about $3.62. And in an average day, this stock can move almost $9. That's our, our average true range over the last 14 days. And so if we said, well, we're cool with that, it was at 248. We're live in the market. So if we said 263, we could do two of these, right? I'm going to make this first trigger sequence. We're going to buy two. And we are going to right click, opposite order, say, hey, when this gets to 375, get us out. I'm going to make that good till canceled. Confirm and send. So we're risking 500 to potentially make 500. But we're saying we don't need to make 100%. If we could make 50, happy campers. Okay. Am I worried about time decay at the shorter than 45-day expiration? That's a really good question. And that's, so one of the things with a vertical is that your time decay is a little more muted because you have both a short strike and a long strike. And so when you have 32 days, that when you get closer to expiration, if it's through both strikes with a long vertical, what I have tended to notice is that the value of that vertical tends to go up faster because it's kind of confirmation like, okay, it's through both strikes and we're getting close to expiration. So the value of that spread goes up, but there is no guarantee on that. But, so the advantage when you have a shorter time frame is that if it is uptrending, you may hit your profit target faster. If the trade goes against you, though, you have less time to recover. So somebody's asking why 375? Because that's 50% more than 250. So we'd be making $1.25, which is 50% of our risk. And our goal is to make 50%. And so you might say, well, okay, you keep mentioning these example trading plans, like where can I find this example trading plan of which you speak? And this is where I'd say you want to go to make sure you subscribe to the Trader Talks channel from Schwab Coaching on YouTube, because when you first come in, what you'll see is what's currently being taught. Then when you come to playlists, I've created a folder with a bunch of additional content. It's a playlist called the Trade Management Mini Sessions. And if you come in here, I also teach getting started with technical analysis. So I've done a lot of these really short, they're like 2 to 5 minutes long on individual candlestick patterns. So you may want to do some binge learning. And then if you come here, like Friday, we did buy right covered calls. So there's a trading plan for that. Today, we've done long call verticals. Here's an example trading plan for that. Short put verticals. Oh, it just got posted because I just recorded this on Friday. So you'll see there's probably very few views of this. The previous one had, I don't know, 3,000 or 4,000 views. Yeah. So this must have been posted late on Friday. So go check it out if you haven't, watched it. And it really, it includes the 4 components, like what to buy, when to buy, how much, to buy, or your position sizing, and then when to exit, and then a daily routine. Okay. So we're just on, I guess, in this, the when to sell piece, because there's several components to that. So that's a place to access those. Okay, so we've done 2 long call verticals. Let's come and look at CRM. Well, and I want to look at one before that. So let's look at CCEP. So this is Coca-Cola in Europe Pacific. So we have this double bottom pattern setting up, right? Right. Just nod your head in agreement. Yes. But has it broken out yet? It has not. And so are we going to go ahead and place a trade saying, oh, like, look at this, it's been up, like we've only had one down day in the last, 10 or 12 trading days? Like, so what? If and it's not showing that it's about to pull back. So we wait. And there are times when we just wait. So Bogus Chinchilla in the chat is saying, like, I'd be inclined to trade a short put vertical. I don't know if it was on the last trade that we did, where we did an example on Amgen. Okay, so Surf Daddy is saying, what would you call the trade on Amgen? I call it a long call vertical, but some people would call it a bull call spread. And some people would call it a debit spread. Now, I'm not the one that made up all these names, so don't shoot the messenger, because I think trading is confusing enough, like when you first get started, as it is. I call it a long call vertical. You can also call it a debit spread. You can call it a vertical. You can call it a bull call spread. So we're going to look at a short put vertical now on CRM. So CRM or Salesforce has been on the struggle bus, right? Like it's down 36% year to date. And you might say, well, hello, like the market's pretty bullish. Like, why would you consider doing a bullish to neutral trade on something that was downtrending kind of dramatically? And it's like, well, this is a company, a lot of people use their services. They have an attractive, at the current price earnings ratio around 20. And it's come down to this support level. And you might say, well, I want to be more conservative. If I'm thinking about doing a short vertical, like I want to be kind of well under. So the low is 161.40, which it hit on Friday. And then we have a bit of a morning star pattern here where we had these big down days, a candle of indecision or a hammer pattern, and then it's moving to the upside today. So it looks like this support level around the 164-ish mark might hold. And so, could we sell the 160 maybe? It's like, well, let's go and see. Like, could we get enough juice for it to be worth the squeeze? So if we come to July 10th, this is where like that question on time decay. Well, 375 to 410, that's about a, 25, 35 cent spread. Well, that's not bad on a $4 option. This is a bit wide. But if we look at this, would this be worth it? And one of the advantages of this is that you're going to have an accelerated rate of time decay. So if we get paid $1.43, now if we go out another week, would we get paid much more? Like if we went out, to the 17th. So we're going out a third more time. How much more money would we get? And then how much more time decay? What's the benefit of the time decay? So here at the 160 strike on the on July 10th, it's 13 cents a day. Here at 160, it's 11. And this is kind of the opposite in that we're selling something and we want it to decay faster. So if we're getting another, 10 cents a week, even on days like Juneteenth when the market is closed and on Saturday and Sunday. So actually in a week, we're getting another, 14 cents. That's 10% a week more. Okay. But if we look at July 17th, we have more open interest. And so, we could do 2 trades and just compare them, because this is this isn't something you necessarily do in your live account. You might just want to pick one. But, we've got over 1,000 contracts here, and, the bid-ask spread is a little tighter. And so if we said, okay, well, and then, if we round this one out, like, is this even worth our time? Because, if we can make $1.45, how much are we risking? Well, we're risking $5 minus the $1.45, right? So we're risking $3.55. So if I take the 145 and divide it by 355, that's a 40% return for a trade. Potential return for a trade we're looking to be in for 25 days. So if we said, okay, if we're cool with that, let's go ahead and place our exit. Now with our example trading plan on this, we want to get out when we've got an 80% profit. Now, if we come back and meet next Monday and we've got 60% of our max gain or 70%, might we decide to close out the trade? Yeah, absolutely. And is that breaking our rules? Oh, I have a debit. Thank you for pointing that out. So this was this one, 160, we're selling. It's really easy to nick the side and switch it from a sell to a buy. So thank you very much for catching that. I think I was telling you guys on Friday, when my kids were young, it's like, don't think that when you get, you're grown up, you make fewer mistakes. You just get better about being cool about recognizing them when you make them and fixing them as quickly as you can. So thanks, Chris. So that's this one that is 25 days out. And we're going to put this in our short put vertical group. And then we're going to compare this to the July 17th. Oops. Okay. So let's come out here now. And, so this is the impact of time, right? And, our probability of this being, of this being in the money at expiration, 37%, a 72% that it could come down and kiss it or touch it. But this means we've got a 63% chance of it expiring worthless. So this one, so we're in it for 30% longer. We're not getting a whole lot more, are we? It's 162 divided by 338. So that's a 47% potential return, but now we're in it for 32 days. So we can make 7% more, but we're going to be in it longer. But we're going to compare them and we'll just see. Right click, opposite order. If we want to get out at 80%, that'll be about 32 cents. So good till cancel. And we're going to compare. Oops. Compare to July 10th expiration. Okay. Let's look at Datadog. And this will have to be our last one. We've got just under 10 minutes left. The time flies, doesn't it? So when I look at Datadog, I say to myself, like, this is up 75% year to date, another stock in the tech sector. And on an average day, this thing can move over $10 a share. Well, we've had a couple of big days, which may have skewed our number a bit on the ATR, but it's come down, to where it really started running from here around this 224-ish level and seems to be bouncing. So could we sell something around that, 220 mark-ish? And so if we look at this and we come out here, well, on the weeklies, we just don't have volume. And even though what did we say, 220-ish? Like you could drive a truck through that bid-ask spread. So that's not even a choice. If we come out here to the monthly and we said we wanted to come to around that 220, right? 220. Well, we've got a tight bid-ask spread. We've got lots of volume, but what's the problem? The problem is that these are $10 wide. And I can tell you right now, we can't afford to place that trade because the bid-ask spread, like even if we get, say, even if we get $3 for it, or between $3 and $4, we're still risking, we're selling a vertical. We get $2. So how much are we risking? We're risking 8. And actually, we wanted this to be 220. Even at $3, we're risking $7 a share or $700. We don't want to risk more than $550. So we don't have the volume to be able to do a weekly with a tighter bid asks, like a tighter strikes. and we can't afford to do the $10 wide strike. But if we were bullish on this, could we come out and sell a vertical? And so we've got lots of volume here on the monthlies. We've got, a tight bid-ask spread. Like this is like 60 cents on a $15 option, or less than that, 55 cents. So could we buy a vertical? And so sometimes when you're kind of looking at things and saying like, well, should I do a short put vertical or a long call vertical? Sometimes it's, it's the strikes and what's available to you that makes your choice. And so if you say, well, I'm going to just look at this, if I do the 230, 240, does that number look unreasonable? Like for it to get that far? It's like, well, in almost a month, in 30 trading days, like till July 17th, like this is bullish in a bullish sector, in a bullish market. That doesn't look like too big a stretch. So we're going to say, okay, we're game to do that. And again, what's our goal? Our goal is a 50% return on this example trade. We're going to make this $7.50 because we want to make a 50% return, or $2.50. So we're saying when this gets to $7.50, get us out and fire in the hole. We're going to put that in our long call vertical bucket. There we go. So what did we do today? So we recently had a survey, and one of the things that the pieces of feedback that came back was, I really like the review at the end. I find it really helpful. So we were looking at doing verticals today. We were talking about, can you do one where the strikes are already through both the stock is trading above both strikes so that your probability of success is higher. We did 3 long call vertical trades, one on PanW, one on Amgen, and one on Datadog. And then we did 2 short put vertical trades on Salesforce CRM. We did one expiring July 10th and one expiring July 17th. And we're going to just compare them and see, how that time decay might work in our favor. Again, when you go out a little further, you have more recovery time if the stock pulls back, but you don't have time decay working as aggressively in your favor when you have more time to expiration. So we'll just see how that plays out in this example. We did 5 examples in total. We reviewed 3 or 4 stocks. We adjusted an entry, a potential conditional entry on DXCM. And so that's a wrap for today. I appreciate you joining us. Here's my ask as we wrap up. If you would please hit the like button, it helps move things up in the algorithms on YouTube so more people can find this content. It also lets Connie and I know that you found this to be valuable. If you'd hit the subscribe button on the Trader Talks channel, like there's over 200,000 subscribers, it's a free resource, and there's lots of great content in there for you to take advantage of whenever you have the time to do so. And then don't forget to follow us in the land of X, Barb Armstrong CS, Connie Hill CS. We're also now on LinkedIn, so please go and find us there as well. So thank you so much for joining me today. Up next, Mr. James Boyd. You'll want to stay tuned for that. Take care, everyone, and have an awesome day. Bye for now.